Welcome back to Investing Talk Podcast.
Today we're looking at Microvast holdings. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For Microvast holdings, ticker MVST, we are really examining a pure momentum story fighting a massive fundamental uphill battle.
Right.
This is kind of the definition of a high-risk, high-reward investment right now, and the first thing you have to look at is that price action.
Yeah, that price action is really what's grabbed everyone's attention. I mean, this has been the top-performing battery stock in 2025, haven't it?
Absolutely.
When we say momentum, we mean a parabolic surge. It's up roughly 800% in just 6 months. Think about that. Climbing from, cents of the dollar to its current trading range, around $5.69 as of, late October 2025?
Mm-hmm.
That kind of run-up generates massive speculative excitement. Just huge.
It absolutely does, but that excitement is exactly where we need to introduce our first major warning sign.
Okay.
When a stock moves that fast, that far, the volatility profile just changes dramatically. If you look at MVST's beta, it stands at 3.23.
Wow, 3.23.
Yeah. Now, for those less familiar, beta measures how much more volatile a stock is compared to the overall market, like the S&P 500.
Right.
A beta of 3.23 means that, theoretically, if the S&P 500 moves 1%, MVST, well, it should move about 3.25%. So you are signing up for basically triple the market risk here.
Triple the risk, which means, I guess, the floor can drop out just as fast as the ceiling appeared, potentially.
Exactly.
However, strictly speaking, from a technical perspective, the picture suggests that maybe for now, the buyers are still largely in control.
That's what the charts seem to be saying, yes.
Yeah.
We see almost all the key moving averages, the 10-day, 20-day, 50-day, 100-day, and even the 200-day, they all align to signal a definitive buy.
All of them.
All of them. This kind of overwhelming consensus in the short, mid, and long-term moving averages, that's a powerful technical force.
Okay. And what about other indicators, like RSI?
Yeah, good question. If we drill down a little further on the technical health, the relative strength index, the RSI, it's sitting at 61.1.
So bullish, but not crazy high.
Exactly. It's bullish, certainly showing strength, but crucially, it is not yet overbought, which usually kicks in around 70 or higher on the RSI scale.
Right.
This suggests that maybe, just maybe, from a pure momentum trading standpoint, there might still be some room to run before, the inevitable technical correction hits.
Okay, so for the short-term trader, someone may be looking to ride this momentum a bit longer. What kind of guardrails are we looking at? What are the key levels?
Well, we're seeing a fairly defined short-term trading range emerge. Analyst targets seem to cluster quite tightly between, say, $5 and $6 for the next 3 months or so.
Okay, so not a huge upside projected short-term then.
No, it projects a pretty modest 5-8% short-term upside from current levels. But the really critical number to watch is the major support level down at $5.
$5, got it.
Holding that line, that $5 mark, sustains the bullish run and kind of confirms the current accumulation phase. But breaking below it would almost certainly trigger a substantial short-term correction. That's your line in the sand right now.
Okay, that covers the technical story, which is clearly fueled by this massive momentum. Let's pivot now to the fundamental picture, because this is where this story gets, contradictory, doesn't it? And requires some serious investor conviction.
Yeah, this is absolutely the core conflict of the investment thesis here. Microvast is a company defined by powerful, really robust top-line revenue growth.
Which sounds great.
But simultaneously, it's defined by rapidly widening losses. They are spending very heavily to scale manufacturing and secure market share, and that spending is really visible on the balance sheet.
And the growth numbers, to be fair, they are genuinely impressive. For fiscal year 2024, the company generated revenue of $379.8 million.
Yeah.
That's a very strong 23.9% increase over 2023.
Nearly 24% growth.
Yeah. And looking at the more recent trailing 12-month period, revenue has grown even further to $422.61 million. So that is, undeniable evidence of expanding demand and effective market penetration. They're selling more stuff.
They are selling more stuff, but here's the challenge. that growth is currently being subsidized by heavy losses.
Yeah.
The company reported a net loss of minus $113.34 million in the last 12 months.
Oof.
Yeah, resulting in negative earnings per share, or EPS, of minus $0.35. And just to underline the risk here, their net losses actually increased in 2024. They didn't shrink, they grew.
Okay, so losses are widening. Why hasn't the market completely sold off this stock then? Especially when we're talking about a high volatility sector. What specific metric are institutions possibly focusing on instead of that negative EPS number?
Well, they are focusing almost entirely on the future. They're essentially saying, look, we accept today's losses because we believe strongly in tomorrow's profit.
Betting on the come,
Yes.
basically.
We see this reflected clearly in the forward PE ratio, which stands at a very high 33.47. That is a loud signal that investors are betting heavily on a near-term turnaround and an earnings inflection point. They are anticipating profitability within the forecast period.
And it's not just, retail speculation driving this valuation, right?
Mhm.
We saw Jim Cramer recently highlight the company on TV.
That's right.
And he specifically pointed out its, quote, free cash flow strength, suggesting that despite the GAAP losses, the underlying business is actually generating cash. And that differentiates it maybe from some of its more cash-intensive, speculative battery tech competitors.
Yeah, and that's a really crucial distinction he made. Institutions are likely looking past the net income statement right now and focusing on the path to operating profitability. And that path is entirely dependent on two key things: their proprietary technology and management's ability to execute a very, very ambitious plan.
Right, the technology, that's what creates the moat, supposedly, and justifies some of this optimism. Microvast isn't just making generic batteries, are they?
No, not at all. They're positioned as a technology leader offering proprietary lithium-ion battery chemistries, specifically things like LTO and LFP. Plus, they maintain strong vertical integration across critical components, which gives them more control.
Okay, LTO, LFP. Let's break those down quickly because you said that's the genuine competitive edge for MVST's chosen market. What makes them different?
Sure. So LTO stands for lithium titanate oxide, and LFP is lithium iron phosphate. Now, these chemistries are fundamentally different from the, say, the NMC or NCA batteries used in most consumer passenger vehicles, like Tesla's,
Okay, different how?
because LTO and LFP offer superior durability, much faster charging capabilities, and a significantly longer cycle life, meaning they can be charged and discharged many more times.
Okay. So maybe not the highest energy density for a sports car, but better for other things.
Precisely. This makes them ideal for commercial fleet operations. Think buses, heavy-duty trucks, port machinery, and also large-scale energy storage integrators. In those applications, uptime, safety, and longevity are often far more valuable than packing the absolute maximum energy into the smallest space.
Gotcha.
So this technological specialization, focusing on that commercial niche, that's really the core investment thesis here.
That focus makes a lot of sense, actually, as they're capitalizing on the huge ongoing global electrification trends, specifically within that commercial vehicle sector.
Yeah.
But okay, they need to transition from being just a technology leader to being a financial leader. What are management's targets? You mentioned they were ambitious.
The targets are very aggressive, yeah. Management has provided a pretty clear pathway, they say, to operating profitability. They are projecting positive adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization of $124 million for 2025.
$124 million next year. That's a massive leap forward from a $113 million loss recently.
It is a huge leap, and furthermore, they are targeting over $200 million in adjusted EBITDA by 2028.
Okay, to put that 2028 goal into perspective, what does that require in terms of sustained performance? Like, what kind of growth rate are we talking?
It requires sustained and, frankly, excellent performance. To hit that figure, they need a compound annual growth rate, or CAGR, of about 19.8% in revenue.
Almost 20% revenue growth year after year.
Year after year, combined with sustained margin improvement through economies of scale as they ramp up production. A CAGR of nearly 20% means they basically can't afford any major operational hiccups or market slowdowns over the next few years. It's a very high hurdle they've set for themselves.
Okay, understood. Let's pivot now to what investors really need to watch out for in the immediate future, because it sounds like this stock is highly catalyst-driven, especially given that high beta we talked about.
Yeah, absolutely. The most immediate catalyst is the Q3 earnings report that's scheduled for early November 2025. Could be the 7th or the 11th, we'll see.
And what's the expectation there?
Consensus expectations are looking for further top-line acceleration, continued strong revenue growth. Now, if they meet or, even better, beat those revenue expectations and show some tangible progress on improving those margins, even if they are still logging net losses overall, that could be a significant short-term trigger for the stock price.
Okay, so Q3 earnings are critical. Looking beyond that report, are there other market events on the horizon that could introduce more volatility? Either way.
Yeah, there are a couple of things. Institutional holding data, the 13F filings, those get released in January 2026. That will show us which major funds have potentially increased or decreased their stakes during Q4.
Right, see who's buying or selling.
Exactly. And additionally, major ETF rebalancing is typically scheduled for December 2025. Both of those events can drive significant liquidity shifts and sharp price moves, reflecting either growing institutional confidence or maybe some skepticism creeping in.
Okay, so all of this brings us back, really, to the inherent risk profile. It sounds like you, the listener, must weigh these substantial technical tailwinds and the growth story against some pretty critical risk areas before considering an investment.
Absolutely. There are at least four major ones we should highlight.
Okay, lay them out first.
First, the execution risk. We've talked about the ambitious guidance. If they miss their margin targets or their revenue targets in the next few quarters, and remember, they are aiming for massive margin improvement to hit those big EBITDA goals, the market will likely punish the stock severely. This is a narrative stock right now, and if management breaks that narrative, the downside could be quite steep.
Makes sense. Risk number two.
Second, the geopolitical risk. Microvast faces material China concentration risk. A lot of their operations or supply chain is tied there.
And why is that challenging?
Well, for two reasons, really. One, it complicates supply chain stability and maybe future expansion plans. And two, it creates investor confidence issues, especially given the current regulatory and trade climate between major global economies like the US and China. Any escalating tensions could directly impact their operations and certainly their future growth projections.
Okay, that's a big external factor. Third risk.
Third, and this is a significant non-financial risk that definitely requires attention, is the governance and legal risk. Just recently, in October 2025, an investor rights law investigation was launched by a firm called Halper LLC.
An investigation. What are they looking into?
They are probing potential breaches of fiduciary duties by Microvast's own officers and directors. Now, why does this matter? Anytime management is facing internal scrutiny and a legal challenge regarding their conduct, it inevitably introduces distraction.
Yeah, it takes focus away from the business.
Exactly. Management's primary focus needs to be on hitting those razor-thin, aggressive profitability targets we talked about, not, defending themselves in legal battles. So this adds a pretty serious layer of uncertainty right now.
Okay, governance risk. And finally, the fourth one.
And finally, the financing risk. Look, the $125 million follow-on equity offering they completed back in August 2025 was probably necessary. It boosted their cash reserves to fund expansion.
Yeah.
But it also resulted in shareholder dilution. If the company continues to require cash injections before achieving sustained positive free cash flow, then existing shareholders face the ongoing risk of further dilution, which obviously erodes the value of their holdings over time. It's sometimes a necessary evil for growth companies, but it highlights the financial tightrope they are currently walking.
Okay, so we started with an incredible 800% run-up, this huge momentum story. And we finished with four pretty critical high-impact risks: execution, geopolitical, governance, and financing. The overall analyst consensus rating is still a strong, bullish 8.5 out of 10. But for you, the investor listening, what does that actually mean in practice?
Yeah, look, Microvast Holdings is really a classic high-growth investment profile that requires a strong stomach for immense volatility. There's no way around that. The proprietary technology, the LTO and LFP chemistry advantage, and the technical momentum are undeniably strong right now. It positions the company perfectly in the growing commercial EV and energy storage markets.
But the big however.
The big however is that this is an investment that hinges almost entirely on management flawlessly executing their ambitious near-term turnaround plan for profitability, and they have to do that while navigating some significant geopolitical and now governance challenges.
So the bottom line seems to be, if they somehow hit that aggressive 2025 EBITDA target, this stock probably flies much higher. But if they falter, even slightly.
If they falter, you should expect a rapid correction, likely back toward that $5 support level we mentioned, or potentially even lower, depending on how badly they miss. It's truly a high-stakes bet on execution right now.